Welcome, everyone. I am absolutely thrilled to have you here for this explainer. If you're studying ACCA financial management, or if you're just genuinely fascinated by how massive businesses actually fund their multi-million-dollar projects, you are in the exact right place. Today, we're breaking down a topic that's literally the bedrock of corporate finance. We're talking about the true cost of capital. Okay, let's dive into this.
So, is corporate money ever truly free? I mean, it's a tempting thought, right? A massive corporation has millions sitting in the bank, so why not just spend it? Well, the reality is, whether a company issues brand new shares to the public or borrows a huge lump sum from a bank, there is absolutely always a price tag attached. Investors expect a solid return, and banks demand their interest. There's just no such thing as free money in business. And quantifying exactly what that money costs, that's our entire mission today.
To get there, here's our deconstruction and reconstruction journey. First, we'll look at the WACC big picture. Then, we'll break down the cost of equity using the DGM and CAPM models. After that, we'll tackle the cost of debt. And finally, we'll bring the whole shebang together using market values.
All right, Section 1, the WACC big picture.
So what exactly is WACC? It's the ultimate metric we're building up to today. Technically, it's the minimum return required by investors, calculated as the weighted average cost of equity and debt, strictly after tax. But in plain English, think of it like this. If a company wants to launch a new product line or build a massive new factory, they absolutely must use WACC as their discount rate. It's the ultimate hurdle they have to jump over. If a new project can't even earn the WACC, it's quite literally destroying shareholder wealth.
And what's really fascinating here is that a company's total funding pool isn't just one giant blob of cash. It's a proportional blend. You've got your equity slice, that's the money from shareholders, and your debt slice, the money borrowed from lenders. And because these two sources carry very different levels of risk, they obviously have different costs. We can't just casually add them up. We have to mathematically weight them based on exactly how much of each the company is actually using.
To really lock this in, I want you to memorize this one-line trigger straight from the source material. WACC is the weighted average cost of equity and debt after tax used as a discount rate. Seriously, burn that sentence into your brain. It is the absolute foundation of everything we're about to deconstruct.
Which brings us to Section 2. Let's look at the cost of equity, starting with the dividend growth model. The classic dividend growth model formula looks like this. KE equals D1 over P0 plus G. Let's translate that into regular language. D1 is the expected dividend for next year. P0 is the current share price, and G is the expected constant growth rate of those dividends. The logic here is honestly beautiful in its simplicity. Shareholders buy a stock for the future cash flows it's going to pay them, right? So this model estimates that required return, leaning heavily on the assumption that a company's dividends are just going to grow at a steady, constant rate forever.
But hold on, because here is a massive warning light flashing for anyone taking an exam. Notice how the formula explicitly uses D1, next year's dividend. It does not use D0, which is the current dividend that was literally just paid. I can't even tell you how many people completely derail their entire calculation right out of the gate by plugging in the current dividend. If the examiner hands you the current dividend, D0, you absolutely must mathematically grow it by 1 year to find D1 before you do anything else. And you do that simply by taking D0 and multiplying it by 1 plus the growth rate.
Okay, let's move to Section 3, the cost of equity, using the capital asset pricing model, better known as CAPM.
Now, you might be wondering, what if a company doesn't actually pay a steady, constantly growing dividend? Well, the DGM totally breaks down. CAPM, however, approaches the problem from a completely different angle. Instead of staring at dividends, it stares at risk. It starts with a baseline, the risk-free rate, which is usually something safe like a government bond yield. Obviously, if you can get that return with zero risk, you're going to demand a lot more to invest in a risky company. So CAPM adds a premium. That premium is the market risk premium, which is just the overall market return minus the risk-free rate multiplied by beta. And beta is absolutely crucial here. It represents systematic risk, basically showing exactly how volatile this specific company's stock is compared to the broader market.
And this brilliantly illustrates the real-world contrast between the two models. So, which one should a company actually use? Well, it entirely depends on the data they have. The dividend growth model is fantastic for those older, mature companies that have a long, somewhat boring history of predictable dividend payouts. CAPM, on the flip side, is generally considered way more robust. It's heavily favored in the real world because it directly reflects an asset's systematic risk based on actual market volatility. It completely ignores the unsystematic, company-specific risks that investors can just diversify away anyway.
All right,
Section 4. Let's switch gears and talk about calculating the cost of debt, or KD.
This represents the specific fee required by a company's lenders, like banks or bondholders. But before we crunch any numbers, we have to understand the fundamental difference between these two financing types. Equity is actually the most expensive source of finance. Why? Because shareholders are literally at the bottom of the pile. If the company goes bankrupt, they lose everything, so they demand the highest return to offset that massive risk. Debt, on the other hand, is significantly cheaper. Lenders get mandatory interest payments, and they rank way higher if the company goes under. But here is the real magic of debt: the tax shield. In most tax systems, interest payments are tax deductible. That effectively reduces the real cost of debt to the company, which is exactly why we always calculate debt after tax.
So how do we actually calculate it? Well, it depends entirely on the type of debt. For irredeemable debt, meaning bonds that just pay interest forever and never actually pay back the principal amount, the formula is incredibly straightforward. It's just the annual interest divided by the current market price of the bond. But pay close attention to that crucial part at the end. You multiply it by 1 minus t, where t is the corporate tax rate. That right there is the tax shield in action, mathematically shrinking the final percentage cost. But let's be real, most debt is redeemable, meaning the company does eventually have to pay the original loan amount back. Finding this cost requires a slightly more complex calculation. Let's move to the internal rate of return, or IRR, and see how this builds. First, you literally lay out the cash flows. You have the current market price as a negative outflow today, the after-tax interest payments as positive inflows over the years, and the final redemption amount as a big inflow at the end. Then you test different discount rates to find a positive net present value, test another rate to find a negative NPV, and then use interpolation to pinpoint the exact rate where the NPV equals 0. That exact magic rate, that's your cost of debt. To really anchor this in your mind, here's your one-line trigger for this section. KD is the after-tax cost of debt. For redeemable debt, use IRR on cash flows. If you can just remember that specific distinction, you are going to save yourself a massive amount of confusion later on.
Finally, we've made it to Section 5, using market values to weight the final WACC.
Okay, so we've got our cost of equity, we've got our cost of debt. Now it's time to bring all these puzzle pieces back together and reconstruct the final WACC equation. To do that, we have to apply the correct weightings to our equity and our debt. And here is where we arrive at the golden rule of valuation. And frankly, the single biggest trap in any financial management exam. You absolutely must use market values, not book values. Do not even look at the historical balance sheet numbers to find your weightings. Those numbers just represent what things cost years ago. Investors today are demanding returns based on what the company is actually worth today.
So, the absolutely crucial point is how you actually find those market values. Luckily, it's very logical. For the market value of equity, you simply take the total number of shares in issue and multiply by the current everyday share price. For the market value of debt, you take the number of bonds issued and multiply by the current market price of those bonds. Once you have those two total market values, you can accurately calculate the proportional weight of each slice of the funding pie. You just multiply your cost of equity by the equity weight, your cost of debt by the debt weight, add those two together, and boom, you have successfully calculated your weighted average cost of capital. We have covered a tremendous amount of ground today, from the DGM and CAPM to tax shields and market values. But I want to leave you with this final, incredibly important thought to ponder. If WACC sets the absolute minimum hurdle rate for a company to survive and grow, what actually happens to shareholder wealth if management decides to invest in a new project that earns a return lower than the WACC? The math dictates that value is actively being destroyed. And that, right there, is why mastering the true cost of capital isn't just about passing an exam. It's about understanding the very lifeblood of corporate decision-making. Thank you so much for joining me on this explainer. Keep learning, keep questioning, and I'll catch you next time.